Hello and welcome to episode 302 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, Happy New Year to you. Oh, and Merry Christmas, of course.
Yeah, Happy New Year, Andy. 2021. I think everybody is glad to see the back of 2020. And not that 2021 looks to be starting any different to which 2020 ended, but it is good to have a new year. So it is a bit of a theme of this week's podcast, actually, the new year vibe, a bit of a new year, new you, new money type of vibe and an outlook on investment. So yeah, Happy New Year, and Happy New Year to all of our listeners out there.
Did you have a good break? And obviously it's a bit of an extended one this year, and with the children going back and stuff, obviously it's a different time, but you had time to properly switch off and relax, I'm assuming.
Yeah, it was slightly different this year because I know I'm always working on Money to the Masses. I kind of was enforced by Justin. You would have listened to the podcast where the team was on. And Justin was basically almost enforced me to have a break over the Christmas period, to have not quite 2 weeks off, but to have that nice break because we were so busy last year, what with the pandemic. I mean, that actually caused a real surge of interest in money for lots of reasons. There are people who unfortunately have been impacted negatively by the pandemic. There were people who had more money as a result of the pandemic and wanted to know what to do with it. So there was a general uptick and demand for money information and guidance. So really all year we were flat out, and right the way up until towards Christmas. So I didn't really take a single day off last year, despite the fact that we were in lockdown. And so I think it was nice to finally have a bit of a break, to come back in the new year refreshed and ready to go again.
Well, actually, that sort of leads us in nicely to what we're going to talk about on this week's pod, talking about being refreshed, new year, new you. We're going to do something similar to what we did last year, aren't we, in this week's pod?
Yeah, so each year we obviously do a piece that's around the new year, new me theme. So you might not realise it, but if you looked at the traffic that you get to Money to the Masses website, podcast, something, there's a massive surge. The first month of the year, so January, is a time where everybody has their New Year's resolutions and decides they're going to do something about their money. And of course, it's a time to capture that enthusiasm. So like last year, we did a short piece on about what to do. And then we do a piece on the investment outlook for the year ahead, because people are obviously going to be investing and intrigued what's going to happen. So I'm going to launch straight into the first piece, actually, which is about the new year, new me, and in relation to money. Now, last year when I did this piece, it's going to be broadly the same, but with some more information and statistics around it. Because, of course, if you're a new listener, we're conscious that we get a lot of new listeners in the new year because people want to find out how to sort their money out, and they might want to listen to a podcast. So if you're new to the podcast or Money to the Masses, then you might be thinking, I'm going to give you a long, long list of things you should be doing going into a new year to sort your money out. Well, the thing is, that is going to be quite a long list, and it's very different for different people because you may have done certain things that other people haven't. So 18 months ago, we did create the Money MOT, and funny enough, we don't talk about it that much on the podcast, given that we created this tool that still is market leading in terms of tech and what it does, because no one else has created one or come close to creating anything as good as what we did. The Money MOT we made 18 months ago, and what it does is you go online to mot.moneytothemasses.com. You will find the tool. You can navigate to the tool from the moneytothemasses.com website. There's a big image on the homepage where you can go through to the tool. And what the tool does is effectively ask you 12 multiple choice questions. It will take you probably 2 minutes at most to whiz through. It's all anonymous. You don't have to register to do it. And what it will do is it takes the answer to the questions you've given and then gives you a star rating, a bit like the kind of Angry Birds theme or some of the games you see. It's not gamification because it's actually serious business. What it does is it gives you a star rating for different areas of your financing, from bills to inheritance tax to insurances, and it breaks it all down and shows you where you're doing well, where you can improve, and where you're doing poorly, and gives you an overall grade. So it gives you, say, a grade from A to E. And you can get pluses in between. So you can get like a B plus, for example. And what that is, that grade is based upon your personal circumstances. It's not based upon anybody else. So, for example, if you are a student, you can get an A. Equally, a billionaire could get a C or a D. It's based upon how well you're doing with your money, given your own personal circumstances and setup. So it's very individual, and it was quite difficult to achieve. So it's one of the key things behind it. So you get a score. You can then get told how you can improve your finances if you want to. And that's the point where you can register to get a free action plan. And you get a series of emails, either daily or weekly, depends on what you choose. And then you will be given a list of things to do that are very easy to do. The whole point is you could do them in minutes, or you could do them within the day at some point, that will improve the areas of your finances that need to be improved. But they are also prioritized. So the things that urgently need to be done are sent to you first of all. So for example, if you need to have a will or something like that. So that is the MOT. So there's no point me talking on the podcast and listing all the things you should do, because the main thing you should do is go to mot.moneytothemasses.com and take an MOT. Now, if you've done it before, it's one of the things you should do every year. That's the point of the tool. That every year you go back again and you retake the test and then see what your score is. Your score will change over time if you retake it. So that's why you need to do it. Retake the test, see how you're doing this year, and then you can then improve your finances, and you can sign up for an action plan if you want to. You don't have to. You can just take the information and go off and try and do things yourself. Now, this has been going on for some time now. We've had an MOT. We don't advertise it out there. We push it out through some of our socials, but there's been a total of 22,791 MOTs done since we launched it. And so that is 22,791 people who've been helped with an MOT to be able to get a snapshot of where they are. Now, from taking that information, like I say, it's anonymous when you just take the test. We can see some pretty eye-opening trends. So I'm going to run through a few of these so people are motivated to take an MOT. So we've looked at all the results, and it looks like 1 in 3 parents do not have any type of life insurance. So, of course, that means if they were to die, then unfortunately their children and their partner will be left potentially in a bad position when it comes to their finances. They could have their homes repossessed. They may not be able to feed their children. And it's one of the key areas we get people to focus on when we give them a money plan. 43% of people have not checked their credit report in the last year. Now, it's good practice to check your credit report at least once a year to make sure there are no mistakes on there, or any credit checks that you are not aware of, or any credit lines that have been taken out that you are not aware of. 48% of homeowners are overpaying on their mortgages. 48% of parents do not have a will. So that's not just about where your assets go, but a will does actually state your wishes of who will be the guardians of your children. Let's say if you and your partner were to die at the same time. 50% of people could save money on their credit card bills. 60% of adults don't know what happens if you die without a will. So those are the rules of intestacy if you want to look them up. But the majority of adults do not know what happens if they were to suddenly die. 64% of people don't know how much inheritance tax they would have to pay if they were to pass away. And interestingly, 94% of self-employed people don't have any kind of income protection insurance. So they don't have any insurance in place to protect their income if they were suddenly incapacitated or unable to work. So those facts and figures show you the sort of thing that we pull out and tell people how to fix those problems. So it's well worth doing if you've not done an MOT, and it's the best way you can start going forward into January and beyond, because you can choose to have the money plan either daily or weekly. So don't just listen to this podcast and think, oh, I'll get round to it. As a starting point, do the MOT. So that's mot.moneytothemasses.com. We'll put a link in the show notes, and see what grade you get, because then when you see what grade you get, you then will be wanting to understand more as to how that was graded, how you achieve that, how you can improve it. And that's how you start to make progress on these things. You start to chip away.
Good stuff. It's always a good timely reminder to look at those things. It's something I always do in the new year, even though I'm sort of more conscious these days of keeping a check on things. I always do my January check. It just makes me feel better. I also do my diet every January as well, try and lose some of those Christmas pounds. Damien, moving on, we've got our annual outlook, if you like, the outlook for 2021. We tend to do this every year now. And so you've picked out some interesting themes that you've picked up on this year, and you're going to cover them in the next piece.
Yeah, so for 80/20 investor members, I always do an in-depth outlook for the upcoming year. So what are the themes that could be coming into play to bear in mind when you're investing, or that could potentially impact your investments? And of course, 2020 it was a crazy year, because if you go back, nobody, if they produce an outlook for the year, would have ever believed or put down a pandemic, and a pandemic that would cause the quickest bear market in history, that would cause some of the worst economic pain in history. So obviously outlooks are just almost forecasts. They're themes, things to bear in mind that could happen. But there are always the black swan events that can come along. They don't tend to happen that often, the black swan events. They tend to happen periodically, like almost every decade or so. So you can't predict those. That's why they're called black swans. But 2020, as I mentioned in the last Damien's Midweek Market, is a timely reminder to expect the unexpected. So with that in mind, what about the almost more expected things that could happen in 2021? Now, last year we looked at the outlook for that the investment banks produce, because obviously investment banks have clients, and pinning their colours to the mast of where they think the market is going to go next year is something that they like to see. And of course, I mean, the investment banks are always going to be optimistic. They're not going to tell you to sit in cash for an entire year, because obviously that wouldn't do their profit line any good. So looking at this year, I'm going to just throw it out there because people are usually quite interested. If you look at the S&P 500, so that's the US equity market, the main indices, or main index, I should say, out there in America, and they are predicting a rally. I've taken the average across a whole range of investment banks and their predictions. They're predicting that the S&P 500 will finish around about 4,100 at the end of 2021. Now, that would mean that we're likely to see about a 12% rally from where we are roughly at the moment. And put that into context, last year, as we moved into 2020, they were predicting a rally of 6.5% on the S&P 500. It turned out, obviously, that they had been slightly pessimistic in that regard, but that was only after the market recovered from that 30% slump when the pandemic hit. So the fact that the S&P finished up higher, they hadn't factored that in, of course, into their prediction. So the point is that 2021, this year, investment banks are predicting is going to be even better than last year. Now, there is one thing that I sort of throw into the mix on that if you think about the valuations of some companies, they are at levels that can seem quite mind-blowing, to be honest. I mean, if you think about Airbnb, its valuation is heading towards almost double what it was before the pandemic. Well, the pandemic pretty much stopped all global travel. So you can see there is a definite euphoria in markets that a company that has been hampered so much by the pandemic has a valuation that's almost twice what it was before the pandemic hit. So, I mean, there are lots of factors as to why that will be. Some of it is the easy money going into markets from central banks, but it shows that the market is very bullish at the moment and is predicting that we're going to have a massive rebound economically. Now, economically, we're not predicted to get anywhere near the levels we had before the pandemic for, well, probably not until 2022. So the market is pricing in a rebound from a relatively low base in the economy around the world. A lot of that is going to be based upon the success rate of the vaccine in terms of people taking it and being able to give it to people. So the take-up rate, because don't forget that obviously for countries like the UK that has already started an immunisation programme, there are emerging market countries that are going to struggle with the cost and obviously the storage of some of these vaccines. So it's not going to be something that is universally adopted quickly. So in 2021, the investment banks are still predicting that we're going to have a pretty quick rebound in the in economic growth. In fact, I think it was BlackRock said that they compared it to a natural disaster where you get a real quick, sharp shock, but then the recovery is much quicker. And so that shows you what is fueling this kind of animal spirits in equity markets. And at the time of making the podcast, I mean, we haven't obviously started the new year trading as yet, but into the year end, the breadth in the market was very good. That means there were more and more stocks that were breaking up above their sort of 200-day moving averages. Basically, more and more stocks were joining in the rally and more sectors. And so that was very positive. You would be hard pushed to find any almost bearish investors out there. They'd all thrown the towel in, which in itself can be a little bit dangerous because that shows it could be getting to the point of being quite frothy. But one thing to bear in mind is that the market will turn at some point. Will it be this year in 2021? We don't know, but there's a very good chance that it will do, and it could be quite painful. But it doesn't mean that we won't have a period like a quarter of two of very positive growth in equity markets as people become very enthusiastic. It may just be that reality catches up at some point on these valuations, and that might be if the pandemic doesn't disappear as quickly as people had hoped. So the other thing to bear in mind is when you see new highs, as we had done at the end of last year, you are more likely to see another new high after you've had a new high in markets than you are a 10% correction. And in fact, it's about 50 times more likely to occur. So you're more likely, 50 times more likely to see another new high than you are a 10% correction in equity markets. And that was some research I did for 80/20 investor members a while ago that showed that. So there are definitely positive signs in markets. That doesn't mean they will go up in a straight line forever. The other themes that are worth talking about that we're going to be seeing a lot of in 2021 is equities versus bonds is definitely going to be one. So in the first part of 2020, bonds did very well, gilts, treasuries, and they protected your portfolios when the global economy was collapsing. Because don't forget, fixed interest bonds do well, especially the high graded bonds, so treasuries and gilts, do well when the economy is slumping. But of course, if the economy is going to start aggressively growing again and rebounding, then that is generally bad news for bonds, but good news for equities. So when we had the vaccine come along at the start of November, the rotation trade that we had, we saw equities suddenly do really well. I mean, at one point in the sort of mid-December, we were up about 15% on most indices from the start of November to mid-December. That's a huge rally, but bond markets had generally lagged the equity market. So will we see equity markets outperform bonds? And it's largely going to be down to whether the pandemic comes back and the economy slumps further. Because don't forget, there is still a lot of the pandemic fallout that we've yet to see in terms of job losses, particularly in the UK. One of the other things I think is going to be a major focal point in 2021 is the value of the US dollar. So currency exchange rates. The US dollar seems to underpin nearly everything in investment markets. It's had a huge influence in 2020 in particular, where you get some really strong correlations, both positively and negatively. And going into 2021, there are a lot of people, and when I say people, I'm talking about investment bank analysts, who are predicting that the crash that we've seen in the value of the dollar, because it has absolutely plummeted in the back half of 2020, they're going to see that continue into 2021. And some are anticipating almost a 20% fall. That's a huge number. The point is, whether that number is true or not, the consensus seems to be for the dollar to continue to weaken. And why could that be? That will be if we see more stimulus from, say, the US government, more stimulus from the US Federal Reserve. They will put downward pressure on the US dollar. So if we see the US dollar fall, that will be good for US equities, but it won't be good necessarily for UK investors who hold them because of the currency exchange rate. So just to break that down, for US equities, it will be positive because obviously if you are a US company exporting, then your goods are cheaper. That's good for you. You can make more money. The problem is if you're a UK investor and you hold stocks in a company like that, then the value of your asset, which will be denominated in dollars, will actually be worth less if the value of the dollar falls against the pound. And so that has a kind of a combination effect with Brexit, because depending on what happens now that we're in a new year, and with Brexit and the value of the pound, if the pound strengthens and the dollar is weakening, then you could see quite a divergence there that will impact portfolios. But on the whole, if we see the US dollar falling, then that will be very good for emerging market assets. So you could see emerging market equities do well. I mean, we've seen one of the fastest floods of investor money into emerging market funds in the back end of 2020 than we had done for years. And that's because people are getting excited about the weak dollar. So the weak dollar is good for emerging markets. You just need to focus on that point. You don't have to really understand all of the intricacies as to why. Commodities is another play. Now, most commodities are denominated in dollars, so a weak dollar is positive for them. That means if we see a very weak dollar, we could see things like gold do quite well. We could see oil do well. And commodities have been pretty much, depending on which commodity you pick, I mean, there have been nuances. For example, the last 2 years, gold has been in a bull market, but if you take them as a group and look at a broad index on commodity prices, we've been pretty much in a downward spiral for about a decade. And commodities, you won't hear many people talk about commodities in portfolios because they've been a way to almost lose money because they've been tumbling in value. At the back end of 2020, when we saw the vaccine, we saw the enthusiasm and optimism around the global economy and the future growth in 2021. That therefore meant that people started buying commodities aggressively. And so they are predicting that with the economy expanding globally, particularly in China, there's an increased demand for commodities. Therefore, that will push the price up. Of course, as I mentioned, the dollar is falling, which is always positive for commodities. So there could be the beginnings of something quite interesting in commodities. And there are people talking about maybe the beginning of a new bull market or a super cycle in commodities, because we do see these big cycles that happen periodically in commodities. And like I say, we've been in a bit of a downward cycle as a group for much of the last sort of 5 to 10 years. So are we going to see something where it gets quite exciting and people start buying commodities again? It leads on to another theme, which is inflation. Are we about to see inflation come back? Because we haven't seen inflation in recent years, or certainly not seen aggressive inflation and gaining traction. But are we about to see it, particularly if the dollar is weakening? Because that means that the cost of things start to go up for US consumers. But equally, if we see something similar in other parts of the world, in the UK, if we continue to keep interest rates low and produce easy monetary policy by, for example, in the UK from the Bank of England, those will all, in the long run, probably start to cause inflation to go up. It's like that analogy when I talk about changing down the gears. And if you start changing down the gears on the car, the revs go up. And if you go too high, the engine can blow. The rev is the equivalent in that analogy of inflation. And so you would therefore start to move the interest rate or the gears back up again to stop the economy, aka the engine, blowing up. So we could start to see people talk about inflation again. And again, an inflation hedge includes commodities. So you can see how these are all interlinked, all these themes that started to be talked about more than they were previously. But a lot of them are all based upon the assumption that we are going to get an economic rebound and the dollar will continue weakening. If any of those things are proved to be false, then a lot of these themes will probably go in the other direction. So it'll be interesting to see. Another thing I just want to mention is obviously we've got to see what the impact of Brexit will be. We don't know that on UK equities. And going forward, UK equities have been a real laggard. They were a laggard in 2020, and they do represent value on a lot of metrics, which means that they are cheap, but cheap is in an attractive way. And if we see the pound strengthen in 2021, then it will put people off holding overseas assets and global funds. They're more likely to want to hold UK funds because therefore they don't get hurt by the currency moves. And you'll probably have a look and see what happens with UK equities. Will they rally as people find them more attractive, especially if we get some political stability? But in particular, UK smaller companies, will they do well? They had a very good end to 2020 after the vaccine was announced, but will that trend continue into 2021? So it's something to keep an eye on. The other thing is keep an eye on the ethical green theme, because a lot of governments are launching, including the UK actually, they launched a £1.3 billion infrastructure investment, which was based around a green theme. So this whole idea of rebuilding economies in a green way should filter through positively for some of the ethical investments that we talked about, for example, in our live event. Again, it's something to bear in mind. I mean, in America, we're going to have a new president that's actually going to be able to take office. We'll have to see what happens with that. As long as that provides stability, markets tend to like that. In the bond space, I mentioned bonds earlier, and I think one final thing would be an interesting one for people to keep an eye on: high yield bonds versus the more boring gilt treasury. So when I say boring, that means low risk. But high yield bonds have started to do quite well, or did start to do quite well at the end of 2020, because they are more linked towards the fortunes of equity markets. And that's partly because if you think, well, bond is a loan to a company. And if a company is providing high yield, that means it's got a higher risk of credit default. Now, if the economy is strengthening, that means the chance of companies defaulting is falling. Whereas if we're in a recession, you see a lot of companies defaulting. So high yield bonds don't tend to do as well. So it'll be interesting to see that dynamic. Will high yield bonds start becoming more prevalent in people's portfolios as they start to outperform during the year if we see this rebound? But that gives you a broad overview of some themes to look at as we go into 2021. And it'll be interesting to see when we come back next year whether the forecast for where markets would be. I mean, you can take that 12% rally that they're predicting in the S&P 500 and translate it across to most other equity markets as being positive, because where the US goes, other markets tend to follow. It'll be interesting to see if that comes to fruition, because like I said at the start of the piece, 2020, if it teaches us anything, it's to expect the unexpected.
Good stuff. I enjoyed that. In preparation for you doing this piece, Damien, I was actually looking over the site and tidying up some bits and pieces, and I happened to read last year's predictions that we did and listen to last year's pod as well. And I was really disappointed actually that I think you really missed the mark last year. You didn't mention anything to do with the coronavirus. I was quite upset. Normally you're so bang on.
Yeah, I failed miserably in any sort of prediction or theme. Let's see if I can do a bit better. Basically, you want the world to be as normal as possible. We don't want any surprises this year. But yeah, we'll see what happens in 2021. Leading on from that, I just mentioned we'll be back to normal next week, because we've had this week, which is an outlook, we had a week off, and then we had obviously the team takeover. So we're going to be back to just me and you, Andy, talking about three pieces on the podcast, won't it?
Yeah. So new listeners who haven't heard us before, that's what we tend to do each week. We pick sort of three evergreen pieces, themes with takeaways, things that you can learn, things that you can action. And that's generally the theme and the gist of the pod. So we'll be back to normal next week. If you do want to get in touch with Damien, you can do so. It's Damien@moneytothemasses.com. Again, if you are a new listener, do check out our Facebook group. It's facebook.com/groups/money to the masses. There's over 2,500 members in there of varying degrees of ages, experience, all in there to try and help each other out in terms of answering questions money related. And actually, if you have a question that you want us to pose on the pod, then pop it in there. We may just cover it in weeks to come. So again, that's facebook.com/groups/money to the masses. Of course, as ever, if you like the podcast, please do head over to wherever you download your podcasts and pop us a 5-star review. It really helps us to spread the word and reach more people. Damien, we're done for this week.
We're done for this week. And so until next time.
Until next time.